HeyMax in Canada, the complete strategic analysis. This is an independent analysis of whether HeyMax, the Singapore rewards platform this series has examined across 12 volumes, should enter Canada. Researched in August 2026 from public sources. Nobody paid for it. Nobody previewed it. Nothing in it is financial advice. Canada is the 13th book in this series, the second stop on a North American tour that began with the United States, and it presents a case neither of its predecessors prepared us for. The American volume studied a completed market, every layer occupied, a mirror with no doorway. The Asian volume studied deficit markets, places where some structural gap gave a small foreign platform something to be. Canada is neither. It is the middle market, too complete to enter, too small to matter. And this is the volume surprise, home to exactly one asset worth a negotiation, which can be acquired without setting foot in the country. The shape of the middle in 4 facts. Canada's loyalty culture is deep and old, the country that produced Air-MILES, one of the world's great coalition programs, and Aeroplan, one of its most admired airline currencies. But its layers are consolidating, not opening. Air-MILES itself is being folded into a bank program this very summer. Canada's interchange pool is being squeezed by federally brokered agreements that cut most merchants' rates below 1%. The middle act of the same political movie Korea finished, and America just started. Canada's transferable currency shelf is taken by an Amex program that transfers at par to 11 partners and by Aeroplan itself. And Canada's scale is what it is: 40 million people, a points-literate minority in 2 metropolitan corridors. And yet, threaded through the audit is one fact that upgrades this volume from a routine refusal to something more useful. Aeroplan is the most promiscuous feeder seller in world aviation. Air Canada's program appears on the transfer rosters of American Express, Chase, Capital One, and Bilt. It sells access to its currency as core policy to more foreign feeders than any program this series has examined. Every airline partnership HeyMax has ever signed required the counterparty to make a sell decision. Aeroplan made its sell decision years ago, for everyone. Which raises the one question this volume genuinely cannot answer from public documents and frames as its central test. At what price? If Aeroplan's wholesale rate clears the funding ceiling this series carries, the correct Canadian strategy is the strangest in 13 volumes. Sign the currency. Skip the country. Same ground rules as every volume, sources for claims, labels on estimates, absences treated as data. 16 chapters. The ground, the field, the people, the gaps, the record, the one number that decides everything, and a verdict with falsifiers. Let's begin. Chapter 1, The Two Solitudes. Canadian loyalty runs on a divide as old as the industry itself, and mapping it is the fastest way to understand the whole market. On one side, the travel currencies, Aeroplan above all, funded by banks and aspiration. On the other, the grocery coalitions, PC Optimum, Scene Plus, Triangle, funded by retail margin and habit. And between them, this summer, a funeral. Air-MILES, the program that once defined coalition loyalty worldwide, is being converted into a bank's in-house points scheme. This chapter walks the map. The 4 that follow take each territory in turn. Start with scale and standing. Canadian loyalty engagement is among the highest in the world per capita. The average Canadian household belongs to more than a dozen programs, and the Big 4, Aeroplan, PC Optimum, Scene Plus, Air-MILES, each count memberships in the many millions, against a population of just 41 million. Loyalty is a national retail language. Groceries are priced in PC Optimum points events. Cinema tickets in Scene Plus. Hardware in Canadian Tire Money, the country's oldest loyalty currency, dating to 1958. This is not Korea's cash rebate flatland and not Japan's optimization guild. It is a broad, mainstream points culture closer to Britain's, built by decades of coalition marketing. The travel side is a one-currency story with a supporting cast. Aeroplan, Air Canada's program, rebuilt in 2020 to community acclaim, is the national aspirational currency, the destination toward which the bank's co-brand portfolios and Amex's transferable points all point. Its gravitational role resembles crease flyers in Singapore, with one enormous difference this volume keeps returning to. Where crease flyer guards its gates, Aeroplan sells access to practically everyone, a promiscuity Chapter 3 documents in full. WestJet Rewards runs a distant second, on a companion voucher model. Porter's program grows with the airline's Eastern expansion, and just acquired new relevance by joining the reborn Air Miles successors partner list. The retail side belongs to the grocers and their bank allies. PC Optimum, Loblaw's program, formed from a merger of two schemes in 2018, is likely Canada's most used points program. A closed loop of grocery and pharmacy discounts, run with app-first sophistication. Scene Plus went the coalition route, born as a cinema program, refounded by Scotiabank and Cineplex, then joined by Empire's grocery banners. A bank retail coalition, assembled in exactly the years Air Miles was collapsing. Triangle holds Canadian Tire's empire. None of the three touches travel meaningfully. All three are entrenched in daily spend, with data operations that would impress the Japanese giants. And the middle, the coalition territory Air Miles, pioneered in 1992 and dominated for 2 decades, is being vacated in real time. The program's owner collapsed into creditor protection in 2023. BMO, its biggest issuer, bought it. And in the summer of 2026, the transition completes. Air Miles becomes BMO Blue Rewards. Balances convert to Blue points. The cash and dream accounts merge. The currency re-anchors to everyday redemptions, 1,500 points for $10, with a partner list rebuilt around Porter, Accor's hotel brands, Instacart, and restaurant chains. Chapter 4 performs the full autopsy. The map needs only the headline. The classic sponsor-funded coalition model, invented in Canada, has died in Canada, and its remains are being absorbed into a bank. 3 observations orient everything that follows. First, the market is old, and its age shows in consolidation rather than innovation. The dramatic moves of the past 3 years, the Air Miles bankruptcy and absorption, the Scene Plus expansion, Aeroplan's revenue-based re-anchoring, are all incumbents rearranging territory, not newcomers claiming it. Canada's last major loyalty launch of consequence was Scene Plus's refounding. A market whose news is consolidation is a market whose structures have hardened. Second, every currency that matters is anchored to a domestic giant, a bank, a grocer, an airline, and usually 2 of them in partnership. The unaffiliated consumer platform simply does not exist at scale in Canadian loyalty. The closest analogs are the cashback minnows and Neo Financial's merchant network, Chapter 7's material. Whether that absence is a vacancy or a verdict is precisely the gap hunt question, and Chapter 9 will apply the ownership test the American volume built. Third, for all its depth, the market is small in absolute terms, 1/10 the loyalty economy of the United States next door, whose programs, media, and card products leak across the border continuously and set Canadian expectations. Canada is the only market this series has studied that lives inside another loyalty market's gravity well. The American shadow will recur in every chapter. In the bank currencies that mirror American rosters, in the media machine that follows American formats, and in the wholesale economics that price Aeroplan for American feeders far larger than HeyMax. The map is drawn, now the money underneath it, because Canada's pool has a property none of this series' 12 prior pools had. A government actively, successfully, and consensually shrinking it. Chapter 2, The Squeezed Pool. The ritual interchange chapter, and Canada's entry is unique in the series. The first pool being shrunk by handshake. Not legislated like Korea's, not besieged like America's. Negotiated downward, government and networks at the same table, with the reductions landing in October 2024. This chapter prices the pool, the squeeze, and what both mean for anyone contemplating a rewards business here. The baseline first. Canadian credit interchange historically ran at an average around 1.5%, set by the networks, uncapped by statute, funding a rewards culture second only to America's. 2 rounds of federal pressure changed the trajectory. In 2015, and again in 2020, Visa and MasterCard voluntarily committed to average rate targets, first 1.5%, then 1.4%, under explicit threat of regulation. Then the December 2023 agreements went further. From October 2024, small merchants, up to $300,000 of annual Visa volume, pay an average in-store interchange of 0.95%, with a further cut to online rates. The government's own framing: reductions of up to 37% for qualifying businesses, covering more than 90% of card-accepting merchants, worth roughly $1 billion over 5 years. Read the design carefully because the details carry the strategy. The agreements are volume-tiered. The corner cafe pays under 1%, while the national chains continue near 1.4%, which means the pool still exists at scale. Large merchant volume dominates card spending, but its direction is unambiguous and its politics are settled. Every future federal budget can revisit the thresholds. The small business lobby that won this round remains organized. And the detail that matters most, the agreements explicitly addressed rewards. Ottawa negotiated to protect the points Canadian consumers earn, meaning the banks absorbed the cut without, yet, gutting programs. A pool being drained gently, with the rewards industry holding a political promise instead of a margin. Now place Canada on the series spectrum because the comparison is the analysis. Korea, interchange legislated to death. No pool, no rewards economy. The volume said no. America, the world's deepest pool, untouched but besieged, rewards maximal, entry impossible for other reasons. Singapore and Hong Kong, uncapped, healthy, the pools that fund HeyMax. Japan, uncapped, opaque, under early transparency pressure. Canada sits exactly between the poles. A real pool, roughly 2/3 of Singapore's rates and falling, sustaining a real rewards culture on visibly borrowed time. The Canadian premium card still earns its points. But every structural force pushes toward the European end state, where capped interchange reduced cards to utilities and rewards to remnants. 3 consequences for this volume's question. First, the funding math for any new rewards proposition is marginal and worsening. A card-linked model builds on a shrinking toll. A commission-funded model, HeyMax's, competes against incumbent programs still subsidized by the large merchant tiers remaining 1.4%. The awkward middle: the pool is too thin to fund an American-style rewards war and still thick enough to keep the incumbents generous. The worst of both configurations for an entrant. Second, the squeeze validates, again, the series interchange doctrine and adds a new variant to the catalog. Canada demonstrates the consensual path. No dramatic legislation. No Durban moment. Just successive negotiated ratchets, each politically irreversible. For HeyMax's home markets, the lesson compounds the American chapters. Singapore's uncapped pool is the global outlier. Regulators everywhere now have 3 procedural templates: legislate, mandate routing, or negotiate. And the strategic conclusion is unchanged: migrate revenue toward partner-funded and wholesale lines before the weather arrives. Canada is what the gentle version of the weather looks like. Note the word gentle. Nobody marched. Nothing was struck down in court. $1 billion simply moved from the rewards pool to the merchant side of the table by mutual agreement, and everyone shook hands. That is how it happens in consensus democracies, which is what Singapore is. Third, the mildly contrarian note: the squeeze marginally improves the one Canadian move this volume will endorse. If bank co-brand economics compress over the coming years, Aeroplan's dependence on bank miles purchases becomes a vulnerability. And programs in that position historically respond by diversifying their feeder base, selling to more partners, in more geographies, at more accessible tiers. The interchange squeeze is, on a 3-year view, a force pushing Canada's national currency toward exactly the kind of promiscuous, tiered wholesale posture that would let a small Asian platform onto its roster at a survivable price. The pool's decline closes the consumer door and oils the wholesale one. The pool priced real, shrinking by agreement, funding the incumbent's generosity on political credit. Now the currency everything in Canadian travel loyalty orbits and the strange, welcoming gate policy that makes it this volume's protagonist. Chapter 3: The National Currency. Every loyalty market this series has studied has a summit currency. Canada's is Aeroplan, and it is the most interesting program this series has examined since JAL Mileage Bank, not for its chart or its scale, but for a single policy that inverts everything the series has learned about flag carrier gatekeeping. Aeroplan sells access to everyone. This chapter profiles the currency, its 2026 turbulence, and the promiscuity that makes it this volume's protagonist. The program, briefly. Air Canada took Aeroplan back in-house in 2019, buying it from the failed spin-off that had made it a cautionary tale in program governance, and relaunched it in 2020 to genuine acclaim. A distance and market-based award chart the community rated among the world's most generous. Stopover pricing that became a hobbyist favorite. No fuel surcharges, and a partner network spanning Star Alliance plus an unusual roster of non-alliance carriers. For 5 years it has been, by consensus of the Canadian points media, the country's most valuable currency and one of the most praised programs anywhere. The anti-Air Miles, proof that a legacy program could be rebuilt around member value. The 2026 turbulence, documented because it recalibrates the value story. In January, earning moved from distance flown to revenue-based. At least a point per dollar on base fares, elite multipliers to 6 times. The standard global migration that rewards spenders over flyers. And from June, award prices rose across broad swaths of the chart, the program's first major devaluation since relaunch, moving the community's tone from celebration toward wariness. Neither change is scandalous by industry standards. Both mark the end of the honeymoon. Aeroplan in late 2026 is a very good program becoming ordinarily managed. Which, as this series has documented from Delta to Cathay, is what programs do when their bank revenue engines mature. Now the fact that reorganizes this volume. Walk the list of places you can buy into Aeroplan with transferable points. American Express membership rewards in Canada and in the United States. Chase Ultimate Rewards, Capital One, Bilt, Marriott Bonvoy. That roster makes Aeroplan the single most broadly fed airline currency in North America, on more major bank rosters than United's own program. And it reveals a deliberate strategy. Air Canada monetizes Aeroplan by selling miles wholesale to anyone with members who want them, foreign or domestic, at tiered commercial terms. Where Singapore Airlines guards crease flyer behind its own ecosystem, where ANA locks itself to one issuer, where Korean Air barely tolerates feeders at all. Air Canada runs its program as an open wholesale business. The anchor question this series asks of every airline, will they sell, was answered by Aeroplan years ago, publicly, repeatedly, in every direction. Why does the open gate matter to a Singapore platform whose members mostly fly Asian carriers? 3 reasons, in ascending order. First, redemption value. Aeroplan is a Star Alliance door, and HeyMax's shelf, for all its breadth, is thin exactly there. EVA and SAS carry the Alliance today. Aeroplan would add award access across the entire Star network, including the trans-Pacific routings through Vancouver and Toronto that serve exactly the corridor this volume maps, with a chart the community globally rates favorably. And no fuel surcharges. Remember what the Japan volume taught about surcharges gutting long-haul value. Aeroplan is the rare program where that toll simply does not exist. Second, the cash for miles asterisk. Aeroplan was on HeyMax's shelf once as a cash for miles decoration, bought at retail, killed in the June pruning with the rest. The relationship to rebuild is not cold. HeyMax's members demonstrated demand, and the removal was a pricing decision, not a partnership failure. The question was never whether Aeroplan would sell. It sells to everyone. The question was whether HeyMax could afford the wholesale tier, which is Chapter 11's arithmetic. Third, the precedent. Bilt, a young American non-bank platform, no airline of its own, sits on Aeroplan's feeder roster on presumably commercial terms. The existence proof matters enormously. Aeroplan's gate admits exactly HeyMax's category of counterparty, the independent transferable currency, and has already priced one. Whatever Bilt pays is, within negotiation error, what HeyMax would pay. And Bilt's continued participation suggests the price works for a points business whose currency is valued at 2.2 US cents. HeyMax's ceiling is lower, that is the entire tension of Chapter 11. But the gate itself is demonstrably open to its kind. The chapter's summary, framing everything after. Canada's summit currency is excellent, newly ordinary in management, and uniquely in this series, structurally for sale to platforms like HeyMax. The Canadian market may be closed, the pool squeezed, the entry case dead on arrival. The currency is a different question entirely. And it is the only question in this volume, with a deal at the end of it. First, though, the funeral this summer deserves its chapter. Because the death of Air-Miles is the clearest lesson in the whole book about what happens to coalitions and to the partners who depend on them. Chapter 4, The Dying Coalition. In the summer of 2026, Air-Miles, the program that taught the world what coalition loyalty was, completes its conversion into BMO Blue Rewards, a bank's proprietary points scheme. This chapter is the autopsy, conducted for the same reason this series performs all its autopsies. The cause of death is a structural lesson. And this one speaks directly to the coalition thesis, at the heart of HeyMax's own strategy. The life first, because the scale of what died deserves record. Launched in 1992, Air-Miles became the definitive sponsor-funded coalition. At its peak, 2/3 of Canadian households collected. More than 100 sponsors, Shell, BMO, Sobeys, the liquor boards, paid to issue miles on their transactions. The blue card was as close to a second national currency as retail loyalty has produced anywhere. The model was pure coalition orthodoxy. A central operator owned the currency. Sponsors bought miles wholesale to reward their customers. Members redeemed for flights and merchandise. The operator's margin lived in the spread and in the breakage. For 2 decades, it printed money. The death was slow, then sudden. The slow part, sponsor attrition. Category exclusivity fights and rising wholesale costs pushed anchors out one by one, and each departure thinned the earn map and weakened the next renewal negotiation. Member disengagement followed as earn velocity fell. A disastrous 2016 expiry policy episode torched a decade of trust in one news cycle. And the retailer-owned alternative rose alongside. Why should Loblaw pay Air-Miles wholesale when its own program kept the data and the margin in-house? The sudden part, the operator's 2023 creditor protection filing. And BMO, the program's banking anchor and biggest remaining sponsor, buying the Canadian business out of the wreckage for a fraction of its once-imagined value. 3 years of bank stewardship later comes the quiet end. The Air-Miles brand retires into BMO Blue Rewards. Balances convert to blue points. The dream and cash split is abolished. Redemption re-anchors to everyday value. 1,500 points for $10 off groceries, with a rebuilt partner list that reads as a bank's perks page rather than a nation's coalition. Now the autopsy findings, each one load-bearing for this series' subject. Finding 1. Sponsor-funded coalitions die of their own cost structure. Every sponsor's wholesale payment was the operator's revenue and the sponsor's permanent temptation to leave. The moment a retailer's data ambitions or margin pressure outgrew the coalition's traffic benefit, exit became rational. And each exit made the next more so. The death spiral was built into the model. The operator's profit was the partner's cost. Forever. Now set this against the coalition HeyMax is assembling in Asia, and the partnership's volume's structural distinction becomes an epitaph-tested claim. HeyMax's federated model. partners funding their own participation because each has a deficit the currency fills, no central operator charging rent, inverts precisely the failure mode that killed the Canadian original. Miles charged partners to belong. HeyMax's partners pay themselves through their own budgets for their own reasons. The Canadian funeral is the strongest evidence in the series that the coalition idea survives only in the federated form. Finding 2, coalition collapse creates less vacancy than it appears. The naive read of Miles' death, 100 sponsors and millions of members orphaned, surely a coalition-shaped hole. The actual dispersal, the grocery anchors had already built or joined their own schemes. The bank absorbed the rump into its proprietary program. The members' habits redistributed to the retail coalitions and the airline currency. The hole closed as it opened, absorbed by incumbents with distribution. The same dynamic the American volume found in every gap. Chapter 9 will test whether any exploitable vacancy survived. The preview, less than the obituary suggests. Finding 3, the conversion itself is a masterclass in what member trust is worth at the end. Balances converting at stated value. No action required. Redemptions honored. BMO is spending real money to close the program gently because the alternative, a confiscation headline, would poison the successor product and the bank's brand with it. Compare the 2016 expiry fiasco, whose backlash forced reversal within weeks. The lesson for every currency operator, HeyMax included. The exit conduct of a program is priced into the entry decisions of every future member and partner. And the industry's archives, Canadian, American, Japanese alike, never forget a confiscation. The funeral closes the coalition era of Canadian loyalty. The grocery and bank programs that inherited the country are the next chapter's subject, but the epitaph belongs to the model, and it doubles as this volume's clearest export. Coalitions run as toll booths die. Coalitions run as settlements survive. HeyMax, building the settlement version an ocean away, should study the Canadian gravestone as the founding document of what not to become. Chapter 5, The Grocery Wars. The programs that inherited Canada from Miles are the retail coalitions. This chapter maps the 3 that matter, PC Optimum, Scene Plus, Triangle, because between them they own Canadian daily spend. And their ownership defines what remains addressable by anyone else. PC Optimum first, the country's default. Loblaw's program, merged in 2018 from 2 predecessor schemes, covers the grocery giant's banners plus Shoppers Drug Mart's pharmacy empire. A footprint touching most Canadian households weekly. Its mechanics are pure retail sophistication. Personalized weekly offers, tuned by purchase history. Points events that function as national sale days. Redemption as groceries at a straightforward cent per point. No travel dimension. No transferability. No partners beyond the family. And no need, the program exists to concentrate grocery share and harvest data, and it does both as well as any scheme this series has examined outside Japan. Its lesson for the map is the same as Rakuten's in the Japan volume. A closed loop this strong is whether, not competition, unpartnerable, unattackable, uninterested. Scene Plus is the interesting one structurally because it is Canada's living counterexample to the Miles autopsy. A coalition that is growing. Born as Cineplex's cinema program, refounded with Scotiabank as co-owner. Then expanded through Empire's grocery banners, Sobeys, Safeway, Freshco. Scene Plus assembled, in the exact years Miles collapsed, a bank grocer entertainment coalition with tens of millions of members. Why does this coalition live while the original died? Ownership structure. Again, Scene Plus is owned by its anchors. The bank and the retailers are the coalition, funding it as their own loyalty infrastructure, rather than paying rent to a third-party operator. The federated lesson repeats with a Canadian accent. Coalitions survive when the participants own the settlement layer. Scene Plus touches travel only glancingly, through flat value redemptions on the bank's booking portal. Its trajectory is toward being the number 2 everyday currency, not toward the airport. Triangle Canadian Tire's program, heir to the 1958 paper money, holds the hardware and automotive quadrant with the same closed-loop logic. Earn on the empire, spend on the empire, data to the empire. Loyal, huge, and strategically inert for this volume's purposes. Now the analytical work, what the grocery wars mean for the entry question, 3 findings. First, daily spend earn is fully enclosed. The categories that anchor HeyMax's Asian coalition strategy, groceries above all, the weekly basket the partnership's volume called the heartbeat of any coalition, are, in Canada, the exclusive territory of retailer-owned schemes with no interest in external currencies. There is no Canadian U. No independent grocery coalition seeking a travel exit because the grocers own their programs outright and the one that didn't solve the problem by buying into Scene Plus. The single most productive deal shape in HeyMax's playbook has no Canadian counterparty. Second, the travel-to-daily bridge is one-directional and bank-owned. Where HeyMax's markets feature daily currencies seeking travel exits, U converting to Max Miles, LinkPoint's gap at Trust Bank, Canada's arrangement runs the other way. The travel currency reaches into daily, spend through its bank co-brands and retail linkages. The Starbucks and Uber partnerships. The grocery store card multipliers. The aspirational currency already colonized daily earn through the banks. The daily currencies feel no missing travel limb. Both sides of the bridge HeyMax builds elsewhere are here, already built by incumbents in the opposite direction. Third, the war's data arms race raises the entry bar beyond rates. PC Optimum's personalization engine and Scene Plus's cross-anchor data pooling compete on relevance. The right offer to the right household at the right moment. A game played with loyalty datasets accumulated over decades and grocery frequency signal no travel-side entrant can match. An entrant pitching Canadian daily spend earn would compete not on value but on knowing the customer against incumbents who know every basket since 2018. The Japanese lattice lesson in Canadian form. Daily spend loyalty is won by systems, and the systems are finished. The grocery map complete, 3 closed loops, 1 growing coalition owned by its anchors. 0 external currency demand. Add Chapter 3's national currency and the Canadian board is nearly full. What remains is the bank's own transferable shelf, the layer that would compete most directly with a HeyMax proposition, as the last territory to walk before the gap hunt begins. Chapter 6, the bank shelf. The layer that would compete head-on with a HeyMax proposition is the bank's transferable points shelf. Canada's version is smaller than America's, but structurally identical where it counts. The product exists. It transfers at par, and it is attached to cards the target demographic already holds. This chapter walks the shelf and prices what it forecloses. American Express Canada anchors it. Membership rewards in Canada transfers 1-to-1, instantly, to a roster that reads like a compressed version of HeyMax's own ambitions. Aeroplan, British Airways Avios, Cathay's Asia Miles, Flying Blue, Qatar Privilege Club, Delta, Etihad, plus hotel partners. 11-odd programs spanning 3 alliances and the unaligned Gulf tier. The earn side runs through the Cobalt card, 5 points per dollar on food and groceries, the Canadian Communities workhorse, and the Platinum tier above it. Priced against HeyMax's home proposition, Amex Canada is the local HeyMax for the premium segment. Multi-alliance optionality, par transfers, instant processing, on spend categories covering daily life. The differences: it requires an Amex, with acceptance friction in a Visa and MasterCard country and income gates at the door. And its roster lacks the Asian long tail. Neither difference founds a business. RBC Avian supplies the Visa-side counterpart. A transferable currency reaching British Airways, Cathay, American Airlines, and WestJet at varying ratios, attached to the country's largest bank's premium cards. Less generous than Amex's shelf. Vastly distributed. Beneath the 2 transferable currencies spreads the Cobran layer. TD and CIBC both issue Aeroplan cards. A legacy of the fight for Aeroplan issuance writes that itself signals how banks value the currency. BMO now pushes its Blue Rewards program. Scotiabank routes to Scene Plus. Every major bank owns a loyalty story. Every premium cardholder already holds one or two. 3 implications close the audit layer. First, the transferable points product is taken at the demographic that matters. The Canadian optimizer, the Prince of Travel reader, the Flyer Talk Canada poster, runs Amex Cobalt for earn, transfers to Aeroplan or Avios, and supplements with a co-brand. The workflow is complete, funded by the shrinking but real interchange pool, and served by exactly the American-style tooling and media machine Chapter 8 describes. Any entrant faces the 5th best version of itself problem at Canadian scale. Second, the Asia thinness pattern repeats. Smaller. Amex Canada reaches Asia Miles and Flying Blues network. The shelf misses JAL, the Southeast Asian tail. EVA. The gap is real, and as in America, it is inventory rather than platform. Fillable by Amex adding partners, or by Aeroplan's Star Alliance network covering the need at redemption time. The wholesale implication, HeyMax's rack as supply, exists at Canadian scale. Which is to say, a fraction of the American version of the same idea because the feeder currencies here are a fraction the size. Third, the shelf explains why Canada's fintech tier never built a currency. Neo Financial, the Calgary unicorn, the country's most successful consumer fintech launch of the decade, built cashback, merchant-funded boost networks, bank account bundles, no currency, no transfer partners. KOHO, the same at the prepaid tier. Wealthsimple, no rewards dimension at all. The Canadian fintechs read their market correctly. Squeezed interchange could not fund a new currency's earn rates. The aspirational shelf was taken by Amex to Aeroplan, the daily shelf by the grocers. They chose cash, the refuge of markets where the currencies are spoken for. When the local unicorns decline to build your product category, with home field advantages you will never have, the message about entry economics is not subtle. The board is now fully walked. A national currency selling access to everyone, retail coalitions owning daily spend, a bank shelf owning the premium segment, cashback minnows in the gaps, and a pool being politely drained beneath all of it. The chapters that follow, the earn layer, the people, complete the inventory quickly because the pattern is already visible. Canada is the American structure at 1/10 the scale, minus the funding depth, plus a government actively lowering the water level. What survives for HeyMax is what Chapter 3 flagged, and the gap hunt will confirm that the only door on the board is the one marked, wholesale, inquire within. Chapter 7, the earn layer. The remaining commercial layers, shopping portals, cashback, fintech rewards, complete Canada's inventory. They compress into one chapter because the pattern is now familiar. American structures at reduced scale, each occupied by an incumbent whose economics an entrant cannot better. The portal layer is program-owned, as in America, with the same operator fingerprints. Aeroplan's e-store pays points per dollar across hundreds of retailers. The Air Miles shops did likewise and transition with the brand. The banks run their own malls. The infrastructure behind North American program portals is the white label tier the American volume mapped, plumbing that serves whoever owns members. An independent portal pitching its own currency faces the identical bind. The airline's first-party portal pays the currency members actually want, with the program's own promotions attached. A third party matches neither. The cashback layer belongs to Rakuten. Again, Rakuten.ca, the Ebates operation, localized, is the category leader with the same brand mechanics as its American parent. Great Canadian rebates and smaller sites fill the enthusiast tail. The scale is proportionate to the country, meaningful, mature, commodity-margined. Nothing about it invites a new commission-funded entrant. And everything about it, including Rakuten's demonstrated willingness in America to convert cashback into points partnerships, is infrastructure an incumbent currency could someday harness. The plausible Canadian version, Rakuten.ca paying out in Aeroplan, the way the American parent pays out in membership rewards, would be one more door closing from the inside, if it ever ships. The fintech fringe deserves its paragraphs because its choices are diagnostic. Neo-financial raised at unicorn valuations on a rewards thesis and built cashback. Merchant-funded boost networks, bank account bundles, no currency. KOHO, prepaid cashback. Wealthsimple, no rewards at all. The pattern among Canada's best-funded consumer fintechs is unanimous. None attempted a points currency. In the country that invented coalition loyalty, their revealed reasoning, assembled from the preceding chapters, the interchange pool could not fund competitive earn. The aspirational shelf was taken. The daily shelf was enclosed. Cash is what remains when the currencies are spoken for. Where the American fintechs found wedges, built in rent, rove in the no-card niche, the Canadian equivalents found none, because the Canadian incumbents left fewer. Aeroplan's non-card earn coverage already serves the credit-thin traveler, and no spend category of consequence sat unclaimed. One more fringe entity completes the map because its shape rhymes with HeyMax's lattice. The receipt offers apps, Drop, Ampli, and their peers cycled through Canadian fintech in recent years. Most are now shuttered or pivoted. Their epitaphs echo the American receipt tier's economics without its scale. Data monetization rewards need consumer goods advertising budgets concentrated enough to fund them. And Canada's version of those budgets flows through the grocer's own retail media networks. Even the data-funded model, the one earn economics that dodges both interchange and commissions, found no Canadian foothold. Close the inventory with the tally the last 5 chapters assembled. Daily spend, enclosed by retailer-owned programs. Premium transferable, Amex and aviation. The national currency, excellent promiscuous wholesale open. Coalition, consolidated to Scene Plus and a bank conversion. Portals and cashback, program-owned and Rackute. Fintech, cash only by informed choice. The pool, politely draining. Every layer inventoried. Every layer resolved. Canada is a completed market at boutique scale, its completion enforced not by American-style capital abundance, but by the opposite. Margins thin enough that only incumbents with adjacent economics, grocery margin, bank books, airline seats, can afford to play at all. Which sets up the 2 audit chapters that remain, the people who narrate this market, and the gap hunt that will formalize what the inventory already whispers, before the volume turns to what HeyMax should actually do about the one open door. Chapter 8, A Machine in Miniature. Canada's points community completes the market inventory. It can be profiled efficiently because it is the American machine at reduced scale, with 2 Canadian particularities that matter to this volume's verdict. The structure mapped against the series' taxonomy. At the professional tier, Prince of Travel, the country's points media flagship, running a full editorial operation, conferences, and a booking service. Frugal Flyer. Milesopedia, the francophone counterpart serving Quebec. And the personal finance crossover, with Red Flag Deals credit card boards functioning as the community's forum commons. The economics are the American model, localized. Card referrals fund the tier. Welcome bonus cycles drive the content calendar. And the valuation table format has been imported intact. Canadian points valuations publish monthly, in cents per point, with Aeroplan's number watched like a share price. Beneath the professional tier, Flyer Talks Canada boards, Reddit's personal finance and churning communities, and a YouTube layer. The whole apparatus is perhaps a tenth the American machine's size, serving a community concentrated in Toronto and Vancouver. And it professionalized on the American schedule, meaning the pre-professional window that still half exists in Asia closed here years ago. Particularity 1. The community is bilingual and binational in its consumption. Canadian optimizers read American points media as a matter of course. The border's porousness means American card news, valuations, and strategies flow north continuously. And a meaningful slice of the community actually holds U.S. credit files and U.S. cards to access the richer American shelf directly. The consequence: Canadian loyalty expectations are set partly by American standards the local pool cannot fund. A structural grievance that surfaces in every devaluation cycle. And any new entrant would be measured not against Canadian alternatives alone, but against the American products the audience reads about daily. Particularity 2. The community's center of gravity is Aeroplan, to a degree without parallel in this series. The Canadian machine's content mix runs overwhelmingly toward Aeroplan's strategy, sweet spots, stopovers, the co-brand ladder, because the national currency is where Canadian points value concentrates. The June 2026 devaluation therefore hit the community as identity-level news, and the coverage cycle it triggered, wariness and valuation cuts and diversification advice, is still running as this volume researches. A community this concentrated on one currency amplifies that currency's every move. And it would greet a new Aeroplan feeder, incidentally, as straightforwardly good news. More paths into the currency everyone already optimizes. What the machine would do to a HeyMax consumer entry follows from the audit chapters and needs only a paragraph. The mechanics coverage would be competent and fair. The comparison table against Amex to Aeroplan would be terminal. And the American standards lens would make HeyMax's earn rates look thin twice over, once against the local shelf, once against the imported expectations. Fair, fast, fatal. The American reception at Canadian scale. But note the inversion this volume has been building toward, because the people chapter is where it lands cleanest. The same machine that would bury a HeyMax entry would celebrate a HeyMax Aeroplan partnership from the other side. A new international feeder into Aeroplan is content the Canadian machine covers eagerly. Every development in Bilt's Aeroplan relationship received friendly cycles. And on HeyMax's side of the Pacific, the Singapore and Hong Kong media adding Aeroplan to the transfer roster would cover it as shelf news of the first order. A Star Alliance door. A beloved chart. No fuel surcharges. The people, like every layer before them, point the same direction. Nothing to enter, something to sign. The inventory is complete market, money, currencies, coalitions, banks, earn layer, people. What remains before the deal chapters is the formal machinery. The gap hunt under the ownership test, the record, the corridor, and the wholesale arithmetic that decides whether this volume's one door actually opens. Chapter 9, The Gap Hunt. The American volume built a method this chapter now reuses: hunt every candidate gap, and test each not just for existence, but for ownership. Does the gap's natural owner look like HeyMax or like someone else? Canada offers 4 candidates. Run them. Candidate 1, the Post-Air MILES coalition vacancy. The country's coalition program died. Surely its space is open? Tested. Chapter 4's autopsy already answered. The sponsors dispersed to retailer-owned schemes years before the formal death. The members redistributed to PC Optimum, Scene Plus, and Aeroplan's co-brand ecosystem. The bank absorbed the remainder. The vacancy filled as it formed, and its natural owner, demonstrated by Scene Plus's successful assembly in the very same years, is a bank retailer consortium with national distribution. Not a foreign platform. Gap, closed by inheritance. Candidate 2, the no-card traveler. America's One and Bilt wedge transferable currency without credit gates. Does Canada's version stand open? Tested, partially real, structurally owned. Aeroplan itself covers much of it. The program earns through retail linkages, its shopping portal, Starbucks, and Uber connections. No card required. The credit-thin Canadian traveler is served by the national currency directly. A breadth of non-card earn no American program offers. What remains of the wedge, a multi-program transferable currency without cards, is real, but collides with the pool problem. Squeezed interchange means no funding source for competitive earn rates. Which is exactly why NEO and KOHO chose cashback. The gap exists. Its economics don't. Natural owner, nobody, which is its own answer. Candidate 3, the Asia shelf. Amex Canada reaches Asia Miles and Flying Blue. The shelf misses JAL, EVA, the Southeast Asian tail, and Vancouver is demographically the most Asia-facing major city in the hemisphere. Tested. The gap is genuine, and its shape is now familiar from the American volume. An inventory gap, filled program by whoever holds contracts. Rewarding suppliers, not entrants. Canadian scale makes it smaller. The feeder currencies that would buy access are a tenth their American counterpart size. It survives as a minor variant of the wholesale angle. Natural owner, contract holders. HeyMax qualifies as a supplier. Candidate 4, the corridor diaspora. Vancouver and Toronto host among the world's largest Hong Kong, Taiwanese, and mainland Chinese communities. Populations flying the exact trans-Pacific routes HeyMax's roster serves. Tested, the American volumes diaspora analysis transfers almost verbatim. The niche is real. The entry stack it requires is the same closed market. Its natural owner is the incumbent's marketing departments, but the Canadian version adds a twist worth recording. The Hong Kong-Vancouver corridor specifically is bidirectional at a density the American version lacks. Return migration, dual resident households, and HeyMax's Hong Kong operation touches its eastern end today. The serviceable version of this gap is not Canadian entry. It is corridor product depth in Hong Kong, destination earn, and booking inventory for members who fly to Vancouver routinely. The gap's owner, correctly read, is HeyMax's existing Hong Kong app. The synthesis, shorter than the American version because the pattern held. No Canadian gap has a foreign entrant-shaped owner. 2 gaps closed by inheritance and economics. 2 survive as non-entry business, a wholesale variant, and a Hong Kong product feature. The ownership test's value shows in what it prevents. A lazier analysis would have found the Air MILES obituary and the Vancouver diaspora and drafted an entry thesis on both. Both are real phenomena. Neither belongs to HeyMax. One meta-finding closes the hunt because it will matter for Brazil and every volume after. Call it the middle market pattern. America's gaps were closed by capital abundance, every vacancy funded shut. Korea's were closed by pool destruction, nothing left to fund anyone. Canada demonstrates a third closure, gaps closed by incumbent adjacency. A market small enough that every vacancy sat next to an incumbent, a bank, a grocer, an airline whose existing economics could absorb it without a startup's risk. 3 market types, 3 closure mechanisms. 1 lesson. Vacancy analysis must always ask not, is there a gap, but why has nobody filled it? Only when the answer is, no incumbent could, does a foreign entrant have standing. The audit machinery has 1 honest question left that documents cannot answer, the wholesale price, and 2 formalities first, the record and the corridor. Chapter 10, the record and the corridor. 2 audit formalities share this chapter because Canada's versions of both are brief, and the brevity is the finding. The record first by the standard artifact method. The sign-up gate, 4 prefixes, no +1 for North America. Canada has never appeared. The expansion communications, the Asia-Pacific fence of the Series A holds here exactly as it held for America. No Canadian mention in any artifact this series has audited. Careers, 0 Canadian roles ever. The App Stores, passive global listing, no localization. The merchant floor, Canadian brands reachable through global affiliate contracts, commodity plumbing. And the 1 active decision, shared with the American record, Aeroplan's June 2026 removal from the cache for miles shelf. The retreat that, as Chapter 3 established, was a pricing decision about retail bought miles, not a judgment on the partnership question this volume reopens at wholesale. The record, a deliberate 0 with 1 priced retreat, correct in every particular. The American volume's record chapter covered the interpretive ground, and Canada inherits its conclusion wholesale. The 0 is comprehension, not neglect. The corridor in both directions, with the honest sizing the doctrine demands. Inbound to Asia, Canadians flying to HeyMax's markets, real and mid-sized. Canadian arrivals into Japan, Hong Kong, Singapore, and Taiwan run in the hundreds of thousands annually per destination at the top end. Meaningful national flows, a fraction of American volumes. Captured as everywhere by the traveler's own platforms. Canadian cards, Aeroplan bookings. Amex travel, no HeyMax mechanism touches them. no entry-free mechanism could. Scored 0 by the same logic as the American chapter. Outbound from HeyMax's members, Singaporeans and Hong Kongers flying to Canada. The interesting direction for one demographic reason. The Hong Kong to Vancouver corridor is unlike any route pair in this series. Decades of migration built dual resident households, family networks, and traffic density, multiple daily widebodies on Cathay alone, that make Vancouver functionally a Hong Kong diaspora hub. HeyMax's Hong Kong members fly this corridor as family infrastructure, not tourism. What do they need from HeyMax? Booking inventory. Held, the global travel floor covers Canadian hotels and activities. Redemption paths. Held, Cathay, EVA, and the Asian tail serve Vancouver and Toronto. An Aeroplan treaty would add Star Alliance depth and intra-Canada connections on top. Destination earn. The visa configuration thread from the American volume, which generalizes here verbatim. A member month in Vancouver should earn on the ground. Every element is either held or achievable without Canadian presence. The corridor, like America's, is already optimally served by infrastructure that never crosses the border. And the record corridor synthesis writes the volume's operational conclusion early. Canada requires nothing from HeyMax except, possibly, one contract, the Aeroplan treaty that would upgrade corridor redemptions for existing members. Everything else this market could theoretically offer is either owned by incumbents, the entry surfaces, or served already, the corridor. Or economically closed, the pool, the zero holds. The door, if it opens from Singapore. Which leaves the volume's one unresolved number. Every argument so far, the promiscuous gate, the Bilt precedent, the corridor upgrade, converges on a single question the public record cannot settle. What does Aeroplan charge a small foreign feeder for its miles? The next chapter assembles every available clue. Chapter 11, the Wholesale Question. Every argument in this volume funnels into one number nobody publishes: the price at which Aeroplan sells miles to a small foreign feeder. This chapter assembles every clue the public record offers, brackets the answer, and defines the test that settles it. Because on this number alone, Canada is either a one-contract opportunity or a complete null. Frame the target first. The series funding ceiling. A max mile sustainably costs about 1.8 Singapore cents, roughly 1.35 US cents, about 1.85 Canadian cents at current rates. For an Aeroplan treaty at 1-to-1 to be viable, HeyMax must buy Aeroplan points at or under that line. The community values an Aeroplan point at around 2 Canadian cents at redemption. The question is how much of that value Air Canada captures at wholesale, and from whom. The clues in evidentiary order. Clue 1, the co-brand anchor rate. Air Canada's program revenue runs on bank miles purchases, TD, CIBC, and Amex Canada buying points for their card programs at contracted rates. Canadian co-brand economics must clear from a thinner pool than America's. Canadian issuers fund points from interchange averaging 1.4% and falling, against the American 2+. The inference, labeled as an inference. Canadian bank wholesale rates plausibly sit below American equivalents, somewhere in the 1.2 to 1.8 Canadian cent band, because programs price to what their buyers' economics bear, and Canadian buyers bear less. Clue 2, the promiscuity itself. Aeroplan sells to Amex in 2 countries, to Chase, to Capital One, to Bilt. Feeder relationships whose per-point rates are unpublished, but whose existence at that breadth signals a program optimizing for volume across many buyers, rather than scarcity pricing to few. Compare the alternative strategy, ANA's single exclusive premium in Japan, and Aeroplan's posture reads as a seller working down the demand curve. Majors first, then challengers, each tier priced to close. A program that signed Bilt, a 5-year-old startup, has a tier that prices startups. Clue 3, the Bilt precedent run through Bilt's own economics. Bilt's points are valued at 2.2 US cents, and Bilt's rewards funding is thinner than a bank's. For Aeroplan membership to make sense in Bilt's model, Bilt's wholesale rate plausibly sits well under 2 US cents. The community's standing assumption for challenger-tier feeder deals with programs of Aeroplan's class runs 1.0 to 1.5 US cents. That band straddles HeyMax's 1.35 cent ceiling, which is precisely what makes the question live rather than closed. The answer is not obviously yes, and not obviously no. It is one conversation away. Clue 4, the direction of travel. Chapter 2's squeeze, bank co-brand economics compressing as interchange falls, pushes Aeroplan toward feeder diversification over time. Chapter 3's revenue-based reanchoring and June devaluation signal a program managing its unit economics actively, which cuts both ways. A cost-focused program prices carefully. But a growth-focused loyalty business, and Air Canada talks about Aeroplan's expansion in every investor cycle, needs new demand sources. And Asian feeder currencies are an unopened channel. No Asian platform of any kind currently feeds Aeroplan. HeyMax would not be joining a queue, it would be opening a region. The bracket then, stated with all its uncertainty. Aeroplan's challenger-tier wholesale rate plausibly falls between 1.0 and 1.5 US cents per point, a range whose bottom half clears HeyMax's ceiling comfortably, and whose top half fails it. The public record cannot narrow further. What narrows it is a negotiation. One exploratory conversation, with a program whose gate policy guarantees the meeting, and whose Bilt tier proves the paperwork exists. And that defines this volume's operational conclusion, worth stating precisely, because it is the entire Canadian strategy. The correct HeyMax move on Canada is a single wholesale inquiry, prepared with the series' standard terms, governed rates, no exclusivity, corridor co-marketing optional, costing one business development cycle. With a pre-committed decision rule, sign at or under the ceiling. Decline above it, with the relationship warm for reapproach when the interchange squeeze deepens. Either outcome resolves the volume's only open question, at negligible cost. No market entry, no Canadian presence, one price discovery against the most approachable flag carrier program on Earth. With the number bracketed, the remaining chapters can move quickly. Reception, opportunities, threats, the ledger, and the plan all inherit their structure from the audit, and funnel toward the verdict the bracket already implies. Chapter 12, Reception, Opportunities, Threats. 3 audit chapters share one roof, because Canada's versions each compress cleanly. Their structures are inherited from the volumes before. Reception first, for the 2 moves actually on the table. A consumer entry would meet the miniature machine of Chapter 8, competent mechanics coverage, a terminal comparison against Amex to Aeroplan, and the American standards lens making every rate look thin. Fair, fast, fatal, at 1/10 the American machine's volume with identical effect. The wholesale move meets a different reception entirely, and on both shores. The Canadian machine covers new Aeroplan feeders as good news for the currency it orbits. More demand validates the program its audience holds, while the Singapore and Hong Kong media would cover an Aeroplan edition as first-order shelf news, a beloved chart, Star Alliance access. No fuel surcharges, the asymmetry could not be starker. The entry is buried by both machines. The treaty is celebrated by both. Opportunities, counted at Canadian scale. 3, all non-entry. First, and dominant, the Aeroplan Treaty itself, fully priced in the last chapter. The only opportunity in this volume with a contract at the end of it, upgrading corridor redemptions for every existing member, and adding the series' first North American program at a governed rate. Second, the Hong Kong corridor product. The Vancouver-facing feature set the gap hunt assigned to the existing Hong Kong app. Destination earned through the Visa configuration thread, Vancouver inventory curation, the dual resident household served from the Asian side. Third, the Almanac entry, smaller than America's but real. Canada is the world's laboratory for negotiated interchange decline and for coalition model mortality. Both experiments publish results, the rate data, the conversions member retention numbers that HeyMax's home market planning should read annually. Nothing else survives the count. Threats priced with the same discipline. 3. All modest. First, the treaty decline scenario. Aeroplan's wholesale price lands above the ceiling and the volume's one opportunity nulls out. Probability, meaningful. Severity, trivial. The cost was one negotiation and the corridor remains served by existing partners. Second, the American Challenger flank, Canadian theater. Bilt already feeds Aeroplan, and any American Challenger expansion into Asia, the U.S. volume's central threat, could eventually bundle Canadian corridor propositions for the same trans-Pacific diaspora HeyMax serves from Hong Kong. Probability, low on any near horizon. Severity, low. The corridor's Asian end is HeyMax's home turf, defended by coalition assets no American import carries. Third, the interchange contagion data point. Canada's negotiated squeeze is the gentlest template yet for the regulatory, whether this series tracks globally. And its success, $1 billion moved, no bank revolt, no court challenge, makes it the template most likely to be copied by governments that prefer handshakes to statutes. Singapore's included. Probability of the template spreading, material on a 5-year view. Severity, the standing answer, accelerate partner-funded and wholesale lines, unchanged. Its urgency incremented once more. The pattern across all 3 sections is the volume's thesis, enacted. Every Canadian question pushed to its conclusion exits through one of 2 doors. Nothing at any price, or the treaty at the right price. The remaining chapters, the middle market thesis, the ledger and plan, the verdict, formalize the 2-door architecture. Chapter 13, the middle market problem. Before the closing machinery, 1 chapter of synthesis. Because Canada crystallizes a market type this series had not yet named, and naming it equips every future volume. The series' market taxonomy as it stood before this book. Deficit markets, structural gaps a small foreign platform can own, Singapore's empty niche, Japan's stability vacuum, Hong Kong's coalition opening, completed markets, every layer occupied by capital that refills vacancies faster than outsiders can reach them, America. Destroyed markets, pools drained until no rewards economy survives, Korea. Canada fits none of these, and the misfit is instructive. Canada has gaps, the hunt found real ones, a no-card wedge half open, an Asia shelf missing, a coalition freshly dead. Canada has a pool thinner than Singapore's but real. Canada has demand, a points culture as deep as any in the world per capita. What Canada lacks is scale at the margin. Every gap is small enough that the incumbent next door absorbs it as an adjacency, rather than leaving it for a specialist. The no-card traveler? Aeroplan's retail earn covers most of the need as a feature. The dead coalition's members, the grocers and the bank absorbed them as customer flows. The fintech rewards opportunity, cashback bolt-ons for the existing players. In a 40 million person market, no vacancy grows large enough to fund an independent company before an adjacent incumbent digests it. Which is why the ownership test kept returning the same answer. And why Canada's most talented fintechs built features, not currencies. Name the type, the middle market, too complete to enter, too small to matter, and derive its strategic properties because they generalize. Property 1. Middle markets are partnership markets. Where entry economics fail on scale, the same demand is often addressable as a single wholesale relationship. Canada's entire opportunity reduced to one Aeroplan contract. A middle market's value concentrates in its few national institutions, and national institutions in small markets are, by necessity, open dealmakers. Aeroplan's promiscuity is not a quirk. It is what a 40 million person home market forces on a program with global ambitions. The rule, in middle markets, ask not, can we enter? Ask, what does the summit institution sell? Property 2. Middle markets are early warning systems. Small, sophisticated, politically cohesive markets move first on regulatory and structural changes that larger markets reach later. Canada's negotiated interchange decline, its coalition mortality, its revenue-based program migrations, all preview dynamics that arrive at scale elsewhere. The almanac value of a middle market often exceeds its commercial value. Watch them, don't enter them. Property 3. Middle markets adjacent to giants are priced by the giant. Canada's rewards expectations, media formats, wholesale rates, and product roadmaps all import from America. Its loyalty economy is, functionally, a tributary system. Any analysis of a middle market must therefore price the giant spillover, which this volume did wherever Canadian numbers were missing, and which explains most of what would otherwise puzzle. Why so small a pool sustains so rich a rewards culture, American set expectations? Why the media machine professionalized early, American formats? Why Aeroplan prices feeders confidently, American buyers? The taxonomy completed for the series use, deficit, completed, destroyed, middle, with the middle types playbook now written, one summit institution inquiry, corridor product from existing markets, almanac subscription, nothing else. Brazil, the next volume in this commission, walks in with the taxonomy ready. And the reader may hold, as a working hypothesis to be tested rather than assumed, the question of which type a 200 million person market with its own supercurrency turns out to be. The answer, this series suspects, will require a fifth category. But that is the next book's problem. The closing machinery follows. Ledger, plan, verdict. Chapter 14, the ledger and the plan. The partnership ledger, then the operating plan it implies. Merged, because Canada's ledger is one line deep and the plan follows from it directly. The ledger in the standard categories. Held, the corridor infrastructure. Cathay, EVA, and the Asian tail serving Vancouver and Toronto. The global travel floors Canadian inventory. The visa relationships destination earn potential, all of it Asian side, none of it Canadian, reachable and the ledger's entire substance, Aeroplan, gate open by policy. Startup tier proven by Bilt, price bracketed by Chapter 11, approach defined. Behind it thinly, WestJet Rewards, a companion voucher program with no feeder architecture, no deal shape exists. And Porter's program, young, growing, conceivably feeder-curious in a few years as its network matures. A name for the watch file, not the pipeline. Closed, everything else by the audit's findings. The grocer's loops, no external currencies, no deficits. The banks, no distribution deficit of foreign app fills. Neo and the fintech tier, cashback by choice, no currency ambitions to partner with. And BMO Blue, a bank absorbing a funeral, the least likely institution in Canada to add a foreign travel currency to its rebuild. The Canadian ledger, one live line, two watch entries, a page of correct refusals. The plan, 4 items, none requiring Canadian presence, priced together at less than 1/4's business development capacity. 1. The Aeroplan inquiry. This year, the full design from Chapter 11. An exploratory wholesale conversation, standard governed terms, the pre-committed decision rule. Sign at or under the ceiling. Decline warmly above it. The single highest information action available, it resolves the volume's only open number, and either outcome is cheap. Sequenced after the velocity win back from the partnership's volume, if capacity forces a choice. Velocity reopens a market thesis. Aeroplan upgrades a corridor. Both beat every other airline conversation on the global list. 2. The Hong Kong corridor product from home, the Vancouver feature set. Destination earn when the visa configuration ships. Vancouver and Toronto inventory curation in the Hong Kong app. The dual resident households booking patterns served deliberately. A product ticket and a merchandising decision, not a strategy. 3. The Almanac subscription. Canada's 2 live experiments, negotiated interchange decline and coalition conversion economics, reported annually into HeyMax's planning cycle alongside the American feed. 1 analyst day a year. The middle market as instrument panel. 4. The standing zero on everything else. Written down with the same institutional memory logic the American volume established. No Canadian entity, no consumer marketing, no diaspora pilots, no fintech partnerships. With the reasons indexed to this volume's chapters, so the future enthusiast inherits conclusions rather than blank slates. The prohibitions, briefly, because Canada's temptations are the American 5 at lower voltage, plus 1 local. Do not read Aeroplan's open gate as an entry invitation. The gate sells miles. It does not sell market access, distribution, or any part of the entry stack this volume closed. A treaty sign should be communicated for exactly what it is, a redemption upgrade for Asian members, and never dressed as a North American expansion. That phrase would write checks the audit chapters have already bounced. This series has watched this company's communications outrun its operations before. The Canadian treaty, if it comes, is the cleanest possible test of whether the Japan-era discipline holds. The ledger closes, the plan stands. 1 inquiry, 1 product ticket, 1 subscription, 1 written 0. The verdict formalizes what the funnel has left. Chapter 15. Should HeyMax enter Canada? 15 chapters, the shortest market volume in this series because the market earned brevity honestly. The verdict in the required form. The verdict: no on entry, and yes on 1 contract. Canada joins the series' refusals with a structure all its own, not America's completed fortress, not Korea's drained pool. The middle market, a loyalty culture as deep as any on earth, operating at a scale where every gap is an incumbent's adjacency, funded by a pool being drained by handshake, in the gravitational shadow of the American giant next door. The entry case fails 4 independent ways. No ownable gap, the hunt returned incumbent adjacency on every candidate. No fundable earn proposition, the squeezed pool. No reachable scale, 40 million people, the points minority already optimally served. And no reception path, a miniature American machine applying imported standards. Any one failure would suffice. 4 make Canada the series' least ambiguous consumer refusal. Cleaner even than America's, which at least required pricing a wholesale wall to close. And the yes, precisely bounded: pursue the Aeroplan Treaty. The volume's single discovery is that Canada's summit currency is structurally for sale to platforms exactly like HeyMax, the most promiscuous feeder seller in world aviation. Its startup tier proven by Bilt. Its challenger pricing bracketed within reach of the funding ceiling. Its Star Alliance network and surcharge-free chart precisely the redemption upgrade HeyMax's corridor members would use. 1 negotiation resolves the only number the public record withholds. Sign at or under the ceiling. Decline warmly above it. Either way, the Canadian question closes for years at the cost of 1 business development cycle. The strangest strategy in 13 volumes, and the correct one: sign the currency, skip the country. The working, compressed. The middle market taxonomy did the analytical work. In markets too complete to enter and too small to matter, value concentrates in what the summit institutions sell. And Canada's summit institution sells openly. Everything else this volume audited: the dying coalition, the grocery enclosures, the bank shelf, the cashback fringe, served to verify that no second door existed. The verification held. 13 chapters of audit. 1 door. The falsifiers on the record: if Aeroplan's wholesale price exceeds the ceiling, the yes half nulls, record the price. Keep the relationship warm against the deepening interchange squeeze. Reapproach within 2 years. If BMO's Blue conversion visibly fails, members defecting en masse, partners orphaned into genuine independence, the coalition vacancy question reopens, and the gap hunt should be rerun rather than assumed. If Canada's interchange agreements collapse or reverse, never yet seen in the global record of such agreements, the pool refills, and the fintech tier's cash-only verdict deserves re-examination. And if a Canadian challenger does launch a transferable currency and survive 2 years, the middle market thesis itself was wrong somewhere. And the error would matter far beyond Canada. What Canada adds to the series, recorded as doctrine: the middle market type and its playbook, summit institution inquiry, corridor product from home, almanac subscription, written 0 on the rest, and 1 mirror lesson the size of the country. Canada is what a mature, beloved, nationally embedded loyalty culture looks like when the pool that funds it politely shrinks. Programs rationalizing, coalitions consolidating into their anchors, fintechs choosing cash. It is, in miniature and in advance, the future this series keeps warning HeyMax's home markets about. And the standing instruction it issues is the same when every volume since the partnership's book has issued, now with a Canadian accent. Build the revenue lines that survive the pool. And own the settlement layer before the consolidation era arrives. Research date, August 2026. Estimates labeled, not affiliated, not financial advice. The next volume goes south. Far south, to the largest loyalty market this series has never touched and a currency with 100 million wallets.